Hello, my name's Jeff Quartermaine and I'm the CEO of Perseus Mining Limited, an Australian gold mining company that operates exclusively on the continent of Africa, where we have 3 operating mines at the present time. We have a large project in development and have several other exploration properties that we're looking at very closely.
Hello, Jeff, and thanks very much for joining us today. Quarterly results out. What do we need to know?
Well, look, it's been another very good quarter at Perseus. It's becoming a little repetitive in saying this, but once again, our operations have performed very well. We've produced something like 237,000 ounces for the quarter at an all-in site cost of $17 an ounce. Now, with a gold price of around $3,000 an ounce, that's giving us $1,560 per ounce margin. So very strong cash flow, very strong residual cash and bullion balances at the end of the year. And if we translate that into our financial year, which ended on 30th of June, I should say, our production for the year was close to 500,000 ounces for the year that we have set ourselves as a target. In fact, it was 496,551. The weighted average all-in site cost for the entire year was $1,235 an ounce, which is fairly credible in global terms. And with the gold price, the average gold price we achieved, we had a margin of about $1,308 an ounce for the entire year. So look, it's been a very, very good year for us once again, and it's got us firmly into a position where we can continue to grow the business and can continue to return capital to our shareholders.
Well, look, and obviously things have gone well on the production side, operations side, and it seems churlish of me to pick you up on a few things, but I'd like to understand better, if I may though, production guidance and ASIC guidance, because obviously those are the things that you can control to a greater degree. So the ASIC is up from last quarter. Why is that?
Well, the ASIC was up for a number of reasons, not the least of which, of course, was that the gold price was a lot higher. And in our particular cost structure, we pay royalties to the government, our host governments. We pay a number of indirect charges that are linked to the gold price. We pay money into community funds that are linked to the gold price. So there are certainly gold price related cost increases. But in addition to that, of course, we have salaries increase, freight has increased slightly and things of that nature. But if you look at our position vis-a-vis guidance, in fact, we've done better than what we guided the market. We guided the market and production to 469,709 to 505,000 ounces, finishing at 496.5. We're about in the 75% range of that guidance. On the other hand, we guided costs at $1,250 to $1,280 an ounce and finished below the bottom end of the cost range. So we were anticipating an increase in costs, and we communicated that to the market. In fact, what we have done is in fact perform better than what we had anticipated we would do. And if I could just show you this slide, which is quite interesting. This slide on the right hand side, the yellow bars is the guidance range that we've given for costs to the market over the last, they're in half yearly intervals, I'd say. So, since COVID, basically back in 2019, and you can see that in the last few years, we've been consistently delivering under the guided range for a variety of reasons. Certainly gold price has been increasing in that period, so that element of the cost structure has been going up. But we do work very hard at keeping a lid on our costs, those things that we can control. Exactly as you said, there are some things you can control, there are some things you can't. We do very well at controlling the costs that are within our power. When costs relate to gold prices, it's a little bit different.
Again, I'm getting into the detail here a little bit, but I think it's always interesting for people to understand the things that you have to try to control and manage. So in terms of improving operation recoveries or reducing reagent consumption or whatever else that you can do to manage the ASIC number, can you sort of talk through the ways that you can control the cost side of things?
Well, look, I mean, you can do a certain number of things, and of course, you can always improve your business. I guess it gets harder and harder as you start to take out the low-hanging fruit, so to speak. But just as a simple example, for instance, in the last 12 months or so, we've changed some of the modelling software that we did in our pits, which has meant that our blasting is more efficient. We get less dilution, we get better breakage. We've changed the actual materials that we use as explosives, which has given us much better breakage, which feeds into better recoveries when material goes through the mill. So there's always these sort of advances that you can make that improve the efficiency of your operation. But on the other hand, you have things like freight, which is outside of your control. I mean, what happened in the Middle East in recent times has certainly added to the cost of moving consumables. You always get salary increases, etc., etc. So look, there is always going to be some measure of inflation, and the challenge that you have is to try to minimise that by introducing efficiencies into your business, and it's something we've done reasonably successfully over time. Hence, if you look at the left-hand side, that black bar there is our cost profile, our all-in-site cost profile over something like 5 years, and you can see that we've been able to keep the cost reasonably static, while at the same time enjoying the benefit of a rising gold price.
Yeah, and obviously, I guess different projects will have different profiles. You're reading Edican, and I don't know. Are they easier? Are you achieving more margin than say Sisingwe? And what are the kind of factors which drive that?
No, well, I mean, Sisingwe at the moment is actually quite high cost, and that has come about through, sort of mine-specific reasons. We are mining satellite deposits. We want to move to a new satellite, but we needed to finish the first one first, and the remnants of that came at a much higher cost than what we were seeing in this current financial year, for instance. So there were some special circumstances around that, but by and large, the main driver of our business in the last 12 months, and in fact for a couple of years, has been Yaouré, where we've done very well from the Yaouré pit, and our cost structure has been quite low. So that's been the real driver of the business.
Okay, and then I've got to come on to hedging strategies. To hedge or not to hedge is the question. How do you treat that mechanism in a market like this?
Yeah, well, that's a very good question. Look, I think the fundamental issue is that our hedging program is quite specifically designed to provide us downside protection, but give us as much upside opportunity as we can have, but at the same time not break the bank, so to speak. We have a capital management strategy. We need to allocate funding to growth. We need to allocate funding to return to shareholders, but we also need to allocate money to ensuring that our balance sheet remains robust. And part of that exercise is our hedging strategy. So what we see from this slide is that until about a year or two ago, we used to use quite consistently forward sales, forward contracts basically, spot deferred or forward contracts. Now, in recent times, with the rise in the gold price, the cost of options has changed quite dramatically. And so some time ago, we switched from using forward sales to using zero cost collars, where we would sell a call option in order to buy a put option, basically. In more recent times, in fact, what we found is that with the rising gold price, the cost of buying those options is quite insignificant in a sense relative to where it's been in the past. So what we have done, you can see this slide shows the remnants of our hedge book, where we have 135,000 ounces forward sold, but we've actually got $160,000 worth of put options at a price of $2,600 an ounce. So should the gold price fall below 2,600, we will exercise those puts. If the price is above 2,600, one of two things will happen. Either we will sell at the higher price, or if it's very high, if it's above 3,600, then our call options will be called. And you can see that there is a differential between the calls and the puts, and that's because we've been able to buy more puts for the cost of a call. So the point that I'm making is this: the management of a hedge book is a dynamic thing. It is not set and forget. We have moved our hedging position from about 24% of 3-year production to around 16%. So we have naturally more upside opportunity, and we feel comfortable doing that in this high gold price environment. But as to the mix of instruments that are used, you need to be very regular in monitoring the market, seeing what opportunities are there, and being prepared to change to suit the circumstances, and that's what we've been doing.
Okay, so it's a layering strategy. It's interesting, and as you say, it's dynamic. Do you treat that at topco level? Do you say, right, or can you do it at project level? Because some projects going to be, you can feel a little bit easier than others, and the risk a little bit lower. Or is this literally a hedge against gold price?
We do a bit of at a company level, at a subsidiary level as well. So it's a managed thing basically.
Right.
It really,
Okay.
it's more complicated than that. I mean, it's that you've got to be able to move money around the group and things of that nature, and different countries have different restrictions on what you do. So this is a part of our centralised treasury function. We have people actively involved in managing this position, and I think over time, judging by the sorts of margins that we've been able to generate, so $1,300 an ounce for the full financial year. You could say, oh, well, if you'd been completely on spot, you might have got a little bit better than that. But part of this is about risk management. Our biggest risk in our business, or one of our biggest risks, is gold price. And for us not to endeavour to manage it, I think, is a little foolhardy, because when you're as old as I am, you can remember those days when, in fact, the gold price goes down. I know it hasn't gone down for a few years, but it does go down from time to time, and that's something that we're very mindful of.
Okay. I think another small thing, just in terms of managing costs and so forth, and managing the balance sheet, I saw, which was a small adjustment for excess waste stripping at Yaouré, and I just sort of made me wonder in terms of, is there sort of like deferred stripping capitalised across the group, and and how and why?
No, it's not that much. There is some stripping, obviously, but I think it's quite interesting actually. If you look at our reported all-in site costs, and then you back calculate movement of cash on balance sheet and correlate that, it's very, very close. So what you see is what you get with Perseus. There is not a lot of deferment or non-cash items come through into the cost line. I know that certainly when we move into the underground situation, we're going to have to look at things a little more closely there, because without a doubt there is development costs that we'll need to manage from a financial point of view. But right now, what you see is what you get. If we say this is our cost, now that's our cost pretty much, and you can work backwards and see how much cash goes on the balance sheet after taking into account the fact that we do spend money on exploration, we do have corporate overheads, and we do have development costs and taxes and royalties. Taxes and dividends, and a share buyback as well.
Right. Okay. And obviously, like during COVID, I think the most companies moved to instead of a just-in-time strategy to building up, pardon me, site level inventories. And I wondered how you treat that at corporate level and at project level. How do you view that? And we transitioning back to just-in-time.
It's all done at a project level or at a subsidiary level. So, and then consolidated into the parent company. And there are some eliminations on consolidation, et cetera. But no, we manage everything as a business units basically, and then bring it together to be able to report on our consolidated group. We'll be publishing those results in August actually for the full year, and certainly I think that. Well, I'm not sure exactly what I can say around that exactly, but they'll be fairly good, I would imagine.
Okay. Well, let's come back to guidance. Obviously, you've kind of put a 5-year guidance out recently, and so people say, well, hang on, what's happening here in 2026? Seems to be falling off. Can you sort of just remind us, the reasons why and what you're going to do about that, and I guess generally kind of growth?
No, well, absolutely. Look, we did put out a 5-year guidance or actually what we're calling a 5-year outlook rather, and we did that a month or more ago. Now, we're not obliged to do this, of course. The reason why we did do this is that there was a school of thought out there, an ill-informed school of thought, I might say, that Perseus was going to be falling off a cliff, having delivered 4 years of 500,000 ounces a year plus, that the end of Edikan was nigh, the end of Sissingué was coming, etc., and that Perseus was going to disappear. I can tell you absolutely that is not the case, and this chart here, which plots out the production over the next 5 years and costs, is pretty clear to see what the story is. Now, there is a dip coming, you're quite right, in fiscal 26. And the reason for that dip is that we were anticipating developing the Maya Sand Gold project in Sudan at a time back in 2023-24, at a time where it would be producing in 26. Now, because we've had to defer that project, there is a dip in our production profile. However, what we have done is we've substituted the Nyanzaga project in Tanzania for Maya Sand. It comes on stream in 27. So while we do encounter a small dip in fiscal 26, by 27 it starts to come back, and as you can see from that chart, 28, 29, etc. is pretty strong. 30, things dip down a little bit again as Edikan and Sissinga get towards the end of the mine life. Now, what a number of people have said to me is, well, look, Jeff, this is all very interesting, but it's a bit boring, isn't it? You're producing, 500 to 600,000 ounces a year, blah blah blah. Where's the upside here? And what I would say, and what I have said to people who have made that comment, is that this projection, this outlook, is based on the ore reserves, the JORC compliant ore reserves that we currently own. 93% of this gold is JORC compliant ore reserves. The other 7% is measured or indicated resource, which will be converted to reserve and drill programs in the next couple of years. The thing is this, though, that if you think that this is all we will do, then you're denying history, because history will tell you that Perseus has grown its business very substantially over the last 10 years through a mixture of brownfields exploration adjacent to existing infrastructure, as well as fairly judicious M&A. Since 2015, in fact, we've acquired 4 companies. So I think, to think that this is all you get, folks, is just simply not correct. This is the baseline. This is what we can guarantee, but there will be some further movement above this as we incrementally add to our portfolio, be it in terms of M&A or acquisition of pre-development projects, or indeed it might even be a case that we acquire projects that have existing production. So I think that what this absolutely does is it presents a very clear picture that Perseus is far from being done. We have a pretty decent future ahead of us. Certainly in terms of fiscal 26, the production guidance is down. It's 400 to 440,000 dollars ounces rather, at an all-in site cost of 1460 to 1620. But once again, I return to the point that history shows that perhaps we have been a little bit conservative in our cost estimation over time, and I can tell shareholders and investors that I would expect that the future will be the same as the past, and that is that we'll be working very hard every day to keep a lid on our cost structure and to introduce efficiencies into our business such that we can produce at the lowest possible costs and maximise our margin, maximise cash flow.
Well, let's get into where that's coming from. Obviously, if you don't mind, a bit more detail on Nyanzaga with Gusti. I mean, first question has got to be simply in terms of project execution, progressing against your FID timeline. Are we still on track for January 2027?
Yeah, well, we absolutely are. I mean, the project's got away to a very good start. Just looking at the schedule as it stands at the moment. So we took the FID in April 25. So we started work on the ground we've been doing relocation housing and roads and things like that for some time, but we've started work on the process plant area, foundations, etc. in July. As I say, working on the relocation housing camps, etc., etc. We're anticipating actually starting mining works in January next year if we can manage that. We were originally targeting April 26, but we're doing everything within our power to commence that in January next year, bringing it forward by 4 months or so. And we will be producing in January 27, I would think, come what may. So even if we start mining 4 months earlier, we'll be producing even more than we were anticipating at that particular juncture. But certainly the program is well and truly on track. We've doing a lot of work, as I said, on infrastructure around the place, camps, buildings, etc., etc. The relocation housing exercise itself is going very, very well. This is actually a picture of the camp that we're building. It'll be a terraced, construction as very similar to Yaouré in many respects. The roadworks in the area, we're clearly endeavouring to avoid townships, etc., trying to improve, not to disturb, the life of our host communities. Doing, proper construction work with proper proper drainage, etc. This picture here shows you a few of the relocation houses that are currently under construction, where people's the houses that they're currently occupying occur on the mine site area. So we are, building these as we go. Some of those houses have electricity, others don't. But whatever people have enjoyed in the past, they will enjoy in the future. And of course, very importantly, we observe their cultural, norms, etc., etc. So in some instances, there are, cemeteries and things of that nature that need to be relocated. So there's a lot of very positive things going on the site. In fact, I'd have to say that this particular project, the way that we've set it up and the way that it's being managed, is as good as any project I've ever seen. Certainly, it's right up there with the best. And I think that the cooperation that we've received from the Tanzanian government has been absolutely first class, and from our host communities has been really good as well. So we're very, very happy with the way Nyanzaga is coming along, and I think the prospect of producing in January 27 is very well within our grasp, if not before.
And what are you finding there? Because I want to talk drilling, because in terms of the current infill drilling, and I guess more importantly, the extensional drilling, can you extend the life of mine? We've seen some of the grades coming out. What are those things going to do for you?
Well, absolutely. And I would refer your listeners to a release that we published last week, in fact, on the phase 2 drilling. Now, just to put it in perspective, when we put our FID out, our financial investment decision, we were at pains to point out that, in fact, the resource reserve on which the decision was made was the result of only the first phase of confirmation drilling, and that we were anticipating doing a second phase, which is what we're currently embarked upon. Now, the reserve in the first phase of drilling was something like 2.3 million ounces, something in of that order. And so what we have been doing is a further infill program. And if you can see from this slide, there's two deposits, if you will. There is this one here, which is the main deposit that we are working on, Tusker, and then there's Kilmarnie, which is over to the side. Now, we put out these results the other day from the second phase of drilling, and you can see that, running your eye down that list, that there are some very spectacular hits that we've achieved through that drilling program. And they've come from a couple of areas. They've come from in the bottom of the open pit, so expanding the amount of potential for the reserve that can be mined through open pit reserves, which says if you can do that, then you're going to extend the life of your open pit mine from 11 years as per the first phase to something well beyond that. And certainly the intercepts in grade that we're seeing, give good cause to believe that that is something that's in prospect. And what our intention is that we will bring out an updated reserve statement in the first quarter of 26, which will increase the reserve from the currently announced number. But quite intriguingly, though, we've also picked up a number of intercepts that from mineralisation that is well below the bottom of the proposed pit shell. And those intercepts, that we've seen, give cause to believe that the opportunity for mining using underground techniques at depth are excellent as well. Now, I hasten to add, in case any regulators are listening to this particular call, that we're not claiming there's a reserve down there. There's a lot more drilling that needs to be done to prove the concept. But certainly the early stage drilling says to us is that this is some very, very decent mineralisation here, and we must follow that up, and we must confirm precisely what's there, because on the surface it looks very much like that there is an opportunity to mine at depth using underground techniques, which may well mean that, in fact, rather than going all the way down with our pit shell, we might stop part of the way and do a trade-off between the costs of waste stripping at an open pit versus underground mining. But in the process, extend the life of this project a long way beyond the currently envisaged 11 years.
So what does that do in terms of the conversations around, clearly you're going to try and understand the economics and you'll work out what the trade-offs are, but in terms of sequencing, when you have made a statement to the market about, okay, we're going to produce gold in beginning of 2027, if the grades are good and the underground looks good, does that change your mind any, or are you just conscious that you can't let the market down?
Oh no, I don't think it doesn't. It's not changing what's occurring at the top of the ore body. It's it's changing it at depth, right? So you're going to start the way that you envisaged, and it may well be that partway through the process, you change your plan. You might have a different approach to things. But no, it certainly won't. It certainly won't change the initial plan to get out of the way. As I said earlier, I mean, the thing that may change is that if we can get ourselves organised with our mining contractor earlier than currently envisaged, we might get 3 or 4 months of extra mining done, have more ore available once the plant is ready to be switched and fully commissioned.
And so, and again, we've seen a few photos there, which is around community, etc. And you've been drilling and so forth. But just give us a sense of how advanced this is. There was a budget of, I think, just over $500 million with Nyanzaga. I mean, how much has been committed or spent to date? And do you think that budget's going to need to change any?
No, well, I mean, the exact amount of money that we have spent, I mean, is about, I think, including commitments, is about $64 million. So about 20 odd of commitments in terms of open purchase orders, but about $40 odd million has actually been physically spent to date. So we are spending money and we are working fairly hard. A lot of that money has gone into the purchase of equipment, of prepayment of a supply of mills and gearboxes and things of that nature. That's something that we've found works exceptionally well for us, is to make sure we get the equipment ordered early so that we don't have delivery issues causing us to go off schedule as the process moves forward. So we have spent a bit of money early. But no, look, we're well and truly on the path, and as I say, the control systems that have been put in place are very good. This is an interesting project in a sense. It's different to some of the other development projects where in the past you would start developing and you might have, say, 18 months before you really need to think about operational readiness. In this instance, because we're going to start mining hopefully in January next year, we are thinking about operational readiness right now and making sure that we have people and processes and systems in place and standing up so that the day we start that work is the first day of the rest of its life, as it were. And so many of the, the organisational structures, etc., that will serve the mine when it's in full steam production are being set up now as we speak. And I'm talking about safety systems, I'm talking about human resources, I'm talking about community relations, security, etc. So they're being put in place now as if we had a full live operation. And the thing that will come along very shortly will be the operational piece, and we'll have a completely ready mining business available to us.
Okay, well, and just sticking with the kind of the growth component, because at the end of the day, companies need to talk growth story. I'm jumping over to CMA, the underground development, where again you've got a bunch of delivering milestones there: portal development, initial state production, etc. How are things progressing there? What's the update?
Well, things that have been progressing exceptionally well on the ground in terms of readiness. We have had a slight hiccup in the last week or so where some of the regulatory issues have brought about a few challenges. But from a physical point of view, we're going very well. We've identified the locations of the various declines that we're seeking to install, and we've got everything marked out and we're moving forward on these things. We have the mesh, everything in place to be able to be in a position to start cutting these portals very, very soon as the government allows us to do it. We've also got all the services in place, water and power, as everything is being set up. We have orders in place for all the ventilation equipment, and they're will be delivered to the site progressively. And in the mining services area, building the change facilities and admin, etc. All of those things have advanced tremendously in recent time and will be handed over in around August. So we are ready to go. What we're looking to the government for is a decree to set out the terms on which we move forward. Now, that decree has been drafted and has been available for signature for some time. We just found out a day or two ago that in fact the bureaucracy believe that rather than the minister signing it, it needs to be signed by the president. So we're actually working, very well together with the government people to get that signed off and allow us to start to cut those portals. But look, we are in very good shape as far as taking the project itself through, and we're looking forward to to the cooperation of the government to be able to make this the first underground mining operation in the country of Cote d'Ivoire.
Right, and so I guess that says you can't sort of commit to when you expect meaningful feed to come to mill. But can you tell us how the kind of grade compares to the kind of current open pits, and what you think that is going to contribute again to the bottom line?
The grade of the underground is exactly the same as the grade of the open pit because it's the same ore body, right? So we're pushing down. What we will be seeing though is that we don't mine enough ore from underground to completely fill the mill from underground sources. So what we will be doing in future years is blending that high grade CMA ore with lower grade material from the Yaouré open pit. So what you will see as a blend, the grade of the blend will fall from what we have been putting through previously, and there will be a step down in production. So over the last 4 years since we commissioned Yaouré, we were producing, let's call it on average, say 250,000 ounces a year. In the blended combination, it'll be producing around 170, 180,000 ounces a year for the next 10 or 11 years. So there is a step down coming forward, but that's just simply a function of being able to get enough ore into the mill of the right sort of grade.
Right, and where else do you see growth coming for, like in Cosio, etc.? I mean, where's meaningful contribution going to come from in terms of the organic? Because we've talked in the past about, as you say, you can't deny history. Your M&A credibility is there. What would you point us to?
Well, look, I think it's an interesting thing, right at this particular time where gold prices are fairly high. The cost of acquiring anything is very high, and it does cause you to pause and reflect and think about the return on funds employed, etc., etc. What we've been switching our attention to recently is the idea of embarking on a very solid greenfields exploration program, taking on board a program of work that might last us. It might take us 10 years to deliver the first mine from that exploration program, but we're willing to do that, and we're willing to commit the human and financial resources to that exercise. So we are giving a lot of serious thought to that at the present time, and we've identified a number of places where we would like to get going, and our teams are starting to get themselves organised to begin that greenfield process. Now, in addition to that, we also do what we normally do, and that is do exploration near our existing infrastructure. So that work will continue. And one of the other things that we have done, and this forms part of this 5-year outlook that we have provided to the market, incorporated into the 5-year outlook, is a number of assumptions around projects like Edikan and Sissingué, where if you look at our original designs, we used, say, $1,300 or $1,400 per ounce to optimise those pits. Now, we've looked at that situation and said, well, what would happen if we were to use, say, $1,800 an ounce? Can we mine more gold by doing another cutback? Well, the answer most certainly is yes, you can. But what it means is that the incremental ounce coming out of those expanded pits will be produced at $1,800 an ounce instead of $1,300 an ounce. Now, we're obviously reluctant to increase our costs, but if we can still generate healthy cash flow given the high gold price, and given that these are not the main games in town, then we are looking at those sorts of things as well. So incorporated into this outlook is a couple of expansions, say at Edikan, where we might do a further cutback on the Fetish pit or another cutback on the Aswaja North pit. There's also some thinking around a further extension of the Sissingué pit as it is at the moment, or opening up another little deposit that we call Airport West, which is down ironically near our airport at Sissingué. But so they're all things that we're working through, and at the end of the day, it's almost like a back-solving problem. How do we maximise cash flow? What do we need to do to generate as much cash as we can possibly do? It may involve a slight elevation in gold price, in all-in site costs, but if you can generate more cash, then that's a good outcome. And the reason why we are so obsessed about cash flow is that, our mission as a company is to generate benefits for all stakeholders in fair and equitable proportions. And for everyone other than shareholders who get capital gains, their benefits take the form of cash. We need cash to pay taxes and royalties to the government. We need cash to invest in local communities. We need cash to pay our employees, etc. So having cash, access to cash, is fundamentally important for us in terms of running our business.
Okay, look, I've always subscribed to the phrase, you got to spend money to make money, or should I say, you got to spend money wisely to make money. And cash flow is one thing, margin is another. You're entering a kind of phase where, okay, the gold price is up, and you will be making a lot of money, and there will be cash flow. And on the other hand, you're also going to be spending a bit of money because you're kind of building up this kind of growth, extended growth profile. So how do you view margin? Is that a big word at board meetings, as well as cash flow?
Margin is the key to cash flow. If you don't get margin, you don't have cash flow. It's as simple as that. And so, you keep an eye on where the price is, you keep an eye on where the costs are, you look at the margin, and you try to maximise that margin. That's why we report production costs, but we also report margin and free cash flow. So,
and how do you think you're doing?
Well, we're going okay. I think the balance sheet tells a pretty fair story, and I like to show this particular slide to investors, and I say to them, well, look, that's not too bad, is it? That's the last 5 or 6 years we've kept our costs flat, we've kept our production growing, and we've been able to take advantage of the rising gold price. That's not a bad track record. So I must admit, I do enjoy pointing to the scoreboard, but then telling people that all of this has been achieved in Africa. All of this has been achieved in that environment that you're so concerned about, and that you put a discount on our share price because you're worried about it. What are you worried about, folks? We have done okay.